So let's take a look at some stock issue considerations. When a company decides to sell stock, they can only sell stock that has been authorized for sale. That authorization comes from the state that they are incorporated in. So the charter of the corporation indicates the amount of stock that a corporation is authorized to sell. And that authorized amount is identified in the financial statements when we list stock in the stockholders' equity section of the balance sheet. A stock certificate might look something like this: the name of the corporation, and each stock certificate is pre-numbered for control purposes. It shows the number of shares of stock that have been issued to the stockholder whose name is in the center of this stock certificate. And it is signed by the corporate official to show that this is truly a share of stock from the corporation. When an individual buys stock for a corporation, the corporation will either issue the common stock directly to the investors, or they'll use an investment banking firm to act as the middleman in the exchange of stock. There are many stock exchanges around the world. However, these are the 5 major stock exchanges that most of us have heard about: the New York Stock Exchange, the NASDAQ, which are both in the United States, the London Stock Exchange in England, the Tokyo Stock Exchange in Japan, and the Euronext, which is overall in Europe. There are other stock exchanges that stock may be sold in. However, these are the primary ones that most people look for publicly traded companies. Most stock is either issued at par or no par. Capital stock that has been assigned a certain value is said to have a par value. Years ago, par value determined the legal capital per share that a company would have to retain to protect its corporate creditors. So, if you had par value stock, they would use that value to determine how much retained earnings had to be kept in the company to make sure that investors and creditors were paid back in the event of a dissolution. Today, many states do not require par value because they watch the value of the stock in the long run, and it's not necessarily needed to maintain a value on the stock to determine the protection for the shareholder and creditors. Typically what happens is when a person invests in stock, they'll pay in capital to the corporation. In exchange for that paid in capital, they will receive either common stock or preferred stock. Common stock is the general voting stock versus preferred stock, which is the stock that gets preferential treatment in the case of dividend distribution and dissolution. Common stockholders take the majority of the risk of the corporation, so once the preferred stockholders have been satisfied with preferred dividends, the common stockholders normally get the remaining dividends. Any amounts that are paid in that are beyond the par value of the common stock or preferred stock is considered paid in capital in excess of par. Throughout the course, we have talked about retained earnings. Remember, retained earnings are the net incomes that has been kept within the company and has not been distributed to the shareholders in the form of dividends. Remember, the formula for retained earnings is the beginning of the year retained earnings plus net income minus dividends equals the ending retained earnings for the period. We use retained earnings either for additional paid-in capital in the form of a stock dividend, or we can pay out the retained earnings to the shareholders in the form of a cash dividend. So when we account for the issuing of stock, we have to identify the specific source of paid-in capital. we have to make sure we keep the differentiation between paid-in capital and retained earnings, primarily because paid-in capital is an investment while retained earnings is coming from the normal operations of the company. So here's an illustration. Assume that Hydroslide Inc. issues 2,000 shares of $1 par value common stock. Let's prepare the journal entry for Hydroslide if the 1,000 shares are issued for $1 per share, and also B, if the 1,000 shares are issued for $5 per share. Remember, it's a $1 par value stock. So if it's a $1 par value stock, we are going to assign a value to the common stock of $1 per share. So if they sold 1,000 shares for $1, the journal entry would be debit cash, credit common stock for $1,000. If the sale was for $5 per share, the company received a capital investment of $5,000, of which $1,000 will be assigned to the common stock based upon the 1,000 shares times the $1 par value, and the remainder, $4,000, will be considered paid-in capital in excess of par value. In the Shareholders Equity section of Hydroslide, they would show the paid-in capital similar to this example. You would show the common stock, then you'd have the paid-in capital in excess of par that would give you the total paid-in capital. Then you would show the retained earnings, adding the retained earnings to the total paid-in capital to get the total stockholders' equity. Now, one of the things that could happen is a company could decide to buy its stock back from the open market. When a company buys its stock back and it does not retire the stock, it in essence is holding the stock for use in the future. It's called Treasury Stock. Now, you can use Treasury Stock in a lot of different ways. For instance, if you have an employee stock ownership plan, a corporation would not issue new common shares of stock to its employees as a bonus or a benefit. What they would do would be to give the employee treasury stock, which is actually common stock that has been purchased for this particular purpose. Also, companies that use stock to buy other companies would use treasury stock as the means for the trade of stock in another investment. So, by definition, treasury stock is the corporation's own stock that it has purchased from prior shareholders and they have not retired the stock. Some of the reasons why companies would buy treasury stock are: 1, to reissue the shares to officers and employees under some bonus or stock compensation plan. The reason why they do that is they do not want to issue new stock because that would change the percentage of ownership of the shareholders. By issuing treasury stock, the percentage of ownership of the existing shareholders would remain the same, and yet they could still compensate the employees by issuing stock. Also, if they have treasury stock, they would be able to increase the trading of the company's stock in the securities market. You may have heard of the term of buying low and selling high. Similar to economics, where we talk about supply and demand, the more stock on the market, the higher the value of the stock. So by buying treasury stock, they have the ability to control the number of shares outstanding on the stock market so that they could manage the price to either a higher or a lower level. They could use treasury stock as an exchange in the acquisition of other companies. In many cases, a company would be willing to take another company's stock in exchange as part of the acquisition process. So normally when we purchase treasury stock, we account for the treasury stock at the price that we acquire the stock for, not the par value, the cost. We debit the account Treasury Stock for the dollar amount paid, and we credit cash. The Treasury Stock is a contra account in the Stockholders Equity section. It is not an asset or an investment in the company. A company cannot own itself as an investment. The Treasury Stock decreases by the same amount when the company later sells the shares. So here's an illustration. On February 1st, 2014, Mead acquires 4,000 shares of its stock at $8 per share. So the journal entry would be 4,000 times 8, or $32,000, as a debit to Treasury Stock, and they paid cash for it, so they would credit cash for $32,000. Both the number of shares issued, the 100,000 shares, and the outstanding 96,000 shares, and the number of shares of Treasury Stock are also disclosed. Note the description under the common stock: $5 par value, 400,000 shares authorized, 100,000 shares issued, and 96,000 shares outstanding. Notice the difference between the 100,000 shares issued and the 96,000 shares outstanding is the Treasury Stock that was purchased on the open market. Another type of stock is preferred stock. Many investors prefer to own preferred stock versus common stock because they get preferential treatment over the common shareholders. Typically, preferred stockholders have priority in the relationship to the dividends that are issued and the asset distribution at the time of the liquidation of the corporation. However, they sometimes do not have voting rights. Each paid-in capital account title should identify which type of stock it relates to: paid-in capital in excess of par for preferred stock or for common stock. So here's an illustration. Stein Corporation issues 10,000 shares of $10 par value preferred stock for $12 cash per share. So if I'm looking at the par value of the stock at $10 and they sell 10,000 shares, the value of the preferred stock is $100,000. So we would want to debit cash for the $120,000 that we received. We would credit preferred stock for the $100,000, which is the 10,000 shares at $10, and then the difference, the $20,000, would be paid in capital in excess of par preferred stock. With preferred stock, they have preference when it comes to dividends. In other words, they receive their dividends first before the common stockholders. Normally, most preferred stock is disclosed to have a certain percentage of the preferred stock's par value as the amount of guaranteed dividends. Now, guaranteed in terms of that they have the preference of getting the dividend before any dividends goes to the common shareholders. Now, management and the other owners of the corporation make the decision of whether they can afford to issue a dividend. If no dividend has been authorized to be given out, the preferred stockholder may not receive a dividend. However, if a preferred stock has a cumulative dividend, that would allow that the preferred stockholders will eventually receive the dividend at the time that the company decides the dividends will be distributed. So let's look at this illustration. Scientific Leasing has 5,000 shares of 7% preferred stock. The 7% is the amount of dividends that will be given out if a dividend is issued for the stock. It has a $100 par value and cumulative preferred stock outstanding. So each $100 pays a $7 dividend. The annual dividend is $35,000, which is the 5,000 shares times $7 per share. if the dividends are 2 years in arrears. In other words, they have not paid dividends for 2 years. The preferred stockholders are entitled to receive the following dividends in the current year. They first receive the dividends in arrears, the $70,000 worth of dividends, and then the current year's dividends of $35,000. So the total preferred dividends would be $105,000. This has to be paid to the preferred stockholders before the common stockholders can receive any dividends because of the nature of being a preferred stock. In the case of liquidation, a preferred stockholder will receive the proceeds of the liquidation first until they get their investment back, at which time then the proceeds will go to the common stockholders.